Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is the 17th of May, and we have Brent crude oil up this morning, up about 0.5%, trading at $83.77, knocking on the door of 84. It's sort of the average price for the year to date. Ultimately, that seems to be both the floor and the ceiling of this oil price, because we've been $10 below and $10 above through the first 4 or 5 months of the year, and yet we're kind of stuck in this happy place, one might say. Peter Maguire, CEO of XM Australia, why is oil not enjoying the same highfalutin elevation that every other market seems to be at? The NASDAQ and the Dow Jones. Dow Jones of 40,000 yesterday. My goodness. Silver and gold and everything else seems to be dancing along, and where oil is sort of stuck in the mud but happy.
Yeah, good morning, Sean. I tell you what, it's certainly, when you run your eye across it, even look at copper, it's nearly 10,500. It's had an enormous rally to the upside in the last couple of months. Silver nearly $30, gold approaching 2,400 US dollars, coming under pressure. And that war premium certainly been stripped out as far as crude. All the hot air's come out of it, and I think it's probably oversold in a lot of ways. You're bouncing now at $80 or just under 80 for WTI. So I think it's probably going to see a little bit, it'll be now a move to the upside. I wouldn't be surprised to put a couple of bucks on by the end of the month. And the US dollar's coming under pressure at 104.40, 104.50. There's probably further softness there. So they're talking, you probably get a rate cut maybe in September. And as you said, equity markets are just on fire, with the Dow where it is 40,000 and 52 or 5,300 for the S&P, strong as well. So yeah, it's been a time to be bullish on equities.
David Fife, chief economist, Argus Media, but still, yet, if all of those other markets are seeing a new dawn, and not a new one, but a continuation of an existing one, and more happy days ahead, why isn't oil coming along to the party? I mean, all of it indicates future growth, future economic opportunity, future energy consumption. Why is oil not moving forward with the same enthusiasm?
Yeah, I mean, good to see you, Sean. I think Peter alluded to a couple of the factors there. We have in the first 3 or 4 months of the year had a bit of a geopolitical premium that seems to have ebbed for now. And when we look at the numbers with our monthly forecasting exercise, actually, demand in the first quarter of this year has been a bit weaker than we anticipated. Partly that's been China, but it's also been OECD demand, oil demand. So demand has been a little bit soft. Having said that, in terms of inventories, we still think there's quite a bit of support for crude, and really all eyes on what OPEC Plus decides to do at their meeting on the 1st of June, because I suspect if they roll over some of their cuts, that could really tighten the market in the second half of the year. So we could see some upside from then on if that happens.
Reva Tania, India's leading energy expert. Your thoughts, same theme, Narendra. Ultimately, when all's said and done, is $84 Brent the same as $30 silver and 10,000 copper? It is the high price. It is the elevated happy price.
Well, I think my sense is that, look, let's not forget that oil has its own universe and it's with its own fundamentals. So yes, commodity, and of course we can always compare, but I think it's in a completely different league. I mean, on the one hand, you see what's happening in Washington, D.C., where the Biden administration seems to be out to just basically, push oil into a deep history as soon as possible. All the initiative, but at the same time, look at economies like India and China, Indonesia, Pakistan, Bangladesh, Africa, Latin America. They need more oil to sustain growth, to pull people out of poverty and expand their economies. So you see that contradiction at the same time. While they have only 1.4 billion consumers of energy in the global north, but here in the global south, we have 6.7 billion energy consumers. So at the end of the day, you see demand is going to be driven by the global south in time to come. So my own sense is that, when it comes to crude oil prices, I think $80 is probably what's kind of going to stay in that region, unless, of course, the Middle East gets out of control or something happens in Ukraine, which we can't see it on the horizon yet, or something happens in the Far East, over Taiwan, we don't know yet. But unless there is that kind of, gigantic, geopolitical trigger, I see absolutely no reason, despite the best efforts by OPEC, Saudi Arabia, and a few others, I don't think oil is going to go beyond $80 per barrel. I mean, in that region, it may 85, 86, it may go down to 76, 75, but the region is going to be about 80. I see absolutely no reason for oil to, I'm talking, of course, the near future, like for 4 or 5 months. I see absolutely no reason for oil to be anything more than $80 per barrel on average.
Peter, we're seeing a number of data points out of China today, which of course is ultimately the big pillar of marginal oil demand growth each year. China's factories up, but consumer down, property weakness continues. Your thoughts on where China's at in order to sort of get a sense of this fair oil price?
Well, Sean, you've got to look, if we look at first off, as we know, the property market's hemorrhaged and it's very anemic and it's going to be a long time to work that through. The talk going back about a year or so ago was 90 million uninhabited apartments and homes. So how long does that take to actually get absorbed through the market? There's the property sector. But the second part is internal demand. We understand the predicament. We've had fairly strong growth. If you're looking at like the CSI 300, it's the best part of 10 to 14, 15% since Lunar New Year. So it's been an enormous rally to the upside for a lot of those Chinese equities. And that's a good sign. So you've got to say that's a positive. As far as energy prices, it's been probably very much China would have to be rubbing their hands with glee in the sense they're not paying $100 for a barrel, they're paying 80 from an import perspective. So that's a plus for them. Their base metal prices of finished goods and so on has got fairly strong demand. And when you're looking at the prices of copper and other metals, they've had a rally as well. So I think that'll be passed on to consumers. So probably China isn't looking too bad, but internal demand is the real issue, Sean. And that's where I think, from debt levels and the banking system, all of those factors are probably a little bit like, the emperor's no clothes. It's starting to understand what the true predicament is in China.
David, I mean, looking at this from the point of view of, obviously in the China case, demand weakness, or, the other side of the inevitable coin, too much supply. We had the IEA earlier this week come out and cut their demand forecast once again by 140,000 barrels per day, down to close to now a little over 1 million barrels a day of demand growth this year. OPEC Plus in their recent report still above 2. There's literally a 1 million barrel a day gap between the IEA and OPEC. Where does the oil price tell you? Are they believing the IEA? Are they believing OPEC Plus?
I think market consensus is probably a little bit closer to the IEA number than the OPEC number. Having said that, our estimate for growth this year is somewhere between 1.4 and 1.5 million barrels per day. We think in terms of China, we're not going to see a repeat of what we saw last year, which was a unique year in terms of the reopening of the Chinese economy and a burst of revenge mobility, if you like, which really goosed up Chinese oil demand growth last year. We're not going to see a repeat of that this year, but we've still got 500,000 or 600,000 barrels a day of growth in demand from China this year. A lot of it is petchems. a lot of it is jet kerosene. So it's a respectable number. It's just pales in comparison with the resurgent demand from China that we saw last year. That was a one-off.
Narendra, big news this week, dominating all the headlines amongst a variety of things, is the trade tariff war that's between China and the US, sort of escalated this week with the US Biden administration adding some significant tariffs, customs duties to the import of particularly electric vehicles, but other sort of clean technologies. As this growing trade war, this particularly elevated tariff war, becomes more and more pronounced, what does that mean for the rest of Asia? What does it mean for India?
Well, you see, I mean, this economic polarization is for real. The fact is that, that the US is trying its level best, basically countries like India, Indonesia, Bangladesh, and Vietnam, and most of the ASEAN countries, and of course, Australia and New Zealand, to be on the American side. And if you look at it with a microscope, that's exactly what's happening because, China, the way China is conducting, its foreign policy and defense policy vis-a-vis neighbors and other countries in the region is not very happy. Countries are not very happy with that. So the result is that, though we have seen the optics of the last 8 weeks where the US looks like, is trying to get back to China to normalize relations, speaking right language, but that has more to do with the situation in Ukraine. And they are also trying their level best that China doesn't get too close to Russia, but it has already happened. That's already happened. So I don't think there's going to make any difference. And China, on the one hand, it has its own worldview, and they are very clear that they want to be a superpower, militarily, if not economically. And they are investing heavily in military, therefore. And so therefore, a lot of this data that's coming from China and all that, many of us in our part of the world don't really buy them, don't trust them. But China is in a difficult spot right now. On the one hand, they need the United States. At the same time, they hate the United States. And the situation for the US is more or less similar. They don't like China anymore. And at the same time, they're trying to contain China to the extent possible. So result is what is there, whether it's a trade war or whether it's a tariff war or this kind of a cold economic cold war and so on and so forth. And that's only going to escalate. And the result is that countries like, Vietnam, Japan, Korea, Australia, India, Bangladesh, most of the ASEAN countries, and many of the countries in the Middle East are going to go with the West or going to go with the US. And therefore, this polarization, economic, trade, energy, politics, everything is going to basically, test Asia's resilience over the next 20, 30 years. So, the fact is that now it's all China versus the United States and many countries, including like India. We have no option but to go along with the West, to go along with the US. And moreover, we are a democracy, liberal country, so we feel more comfortable dealing with them. And
in the immediate, over the big, medium, long term, all of this issue is there through the time horizon. But in the immediate term, India is already benefiting, if you like, from the post-COVID supply chain disruption. We're seeing sort of the idea that manufacturing, high-end technology manufacturing could move to India, is moving to India, new supply chains emerging.
Oh, yes. First, quickly on China. In China, there's nothing short-term. Everything is long-term. What looks like even tomorrow, that's part of their long-term strategy. China always think long-term, the United States always think short-term. That's the problem. You see, but coming back to your question, the end of America-led unipolar world and the new multipolar world is still 20, 30 years away. So that has opened up a lot of areas, a lot of space for countries like India to build its own universe. And that's precisely what India is trying to do. And not only India, some medium powers also like Saudi Arabia, Turkey, and several others trying to do exactly the same. But the point here is that, is China going to go basically its path very quietly? No, that's not going to happen. So I think it's going to be very rough. And therefore, Asia is where you have 4.4 billion oil consumers energy consumers as a whole, and you're going to see kind of lot of turbulence, economic turbulence, trade turbulence, political turbulence, geopolitical turbulence, climate turbulence along the way, because as I said, that India is benefiting. Yes, you're right. Manufacturing. Look at Apple, for instance. These days, when you go to a store in Dubai or San Francisco and Tokyo, you buy an Apple iPhone. Chances are it may be made in India now. So
It's
India
certainly
now,
assembled in
well,
India.
in China also they assemble. When we
Yes,
say
of
made
course.
in
Yeah.
India, they
These
assemble.
are assembly. Peter, Australia has just kind of emerged from a trade war, or it's certainly a trade spat with China. What does all this mean, do you think, for, as Narendra mentioned, the implications for India? Where's Australia? Kind of caught in the middle here.
Well, in some ways, Sean, but I suppose, one of its great saving graces is that we're surrounded by ocean. We've got 26 million people, and we've got deep, deep holes in the ground that give us some of the best ore, metals, diamonds, you name it. We can export it, and coal and uranium to the world. So we're very fortunate in that regard. And geopolitically, we're fairly muted. We've got wonderful agriculture, and we've got so many things that we can
Geopolitically, you're fairly muted.
Well, we are in a lot of ways, Sean. We're not.
If Washington D.C. calls up and says, move 3 yards to the left, I think you're pretty quick moving 3 yards to the left, right? I mean, ultimately, as Narendra points out here, this is getting increasingly to what team are you on, and can you dance down the middle still?
Yeah, well, yeah, we're very aligned with the US. We're very mindful of that. And so, but I was probably, maybe not the word muted was the correct word, but we are in the sense where we're a long way from anywhere. That's probably one of the big saving graces. And
but like America.
Yes, but America faces like Australia, it faces two oceans. But we're an island, whereas America has got it's got naturally from the south. And in some ways, it's being invaded with the migrant issues that they've got at the moment, and of course Canada at the top. But we're really quite unique, and New Zealand is probably even more uniquer. The fabric of our country is we're very prosperous, and we're very fortunate that we've got such wonderful exports to really push into India, push into Asia, and of course China. And they've had insatiable appetites for the last 40 years. And by the looks of it, that will continue to.
Is there any lesson learned that Australia can share with America at the moment, given that you've just been through a rather difficult wicket with China over your wine and all sorts of other bans?
Barley and there was about 7 or 8 different commodities. I think it's just it's a process, Sean. Look, it's not an easy one, and I think that whilst we've been flogged a little bit, we're also very mindful that they're realising that our products are world class, and that's been the benefit, I think, that's from an export model. And also, they're not the only game in town. There are many prosperous areas across Asia. Like they used to buy mangoes from us, and they used to buy great fruits from us, 30 and 40 years ago, and the price of them would be horrendous for rockmelon or cantaloupe in Tokyo. We've got such wonderful fruit baskets that we can export pretty much anywhere across the globe. And so that's been a
diversification ultimately is
to an end consumer. Yes.
David, looking at this in growing industrial competitiveness, which is becoming ultimately a real concern for many countries and driving these protectionist policies, both in the short term and to the medium term as well, I'm wondering your thoughts on how this will impact future energy flows.
Well, I mean, I think the key concern is that when geopolitics and trade tensions rear their ugly head, of course, you're going to end up with suboptimal flows, which is to say, you have the specter of commodities moving over longer distances than they necessarily need to. When you've got things like sanctions and tariffs in place. And ultimately, that means that the consumer is going to pay more, ultimately, than would otherwise be the case in a, what we got used to over the last 20 years, which is a sort of globalizing world. So the risk is that these trade tensions and the reimposition of tariffs, essentially it's going to raise cost, it's going to raise transportation costs. You've got suboptimal supply chains. So that is one element of the equation. But the hard reality is that the things like US crude and LNG are continuing to find their way to market. A lot of people are scratching their head and say, well, how does China respond to the measures that the US has taken? It'd be very difficult, I think, for to see the Chinese responding, for example, with some sort of tit for tat sanctions or tariffs on US energy. They are still highly dependent on imports of key commodities, not least energy.
But on that point, when you bring those two together, David, we are seeing obviously in this window a sort of slowdown in the oil demand growth out of China since COVID, but ultimately it's continuing. And with this competitive, this protectionist, that where China is no longer the world's manufacturing hub, you would imagine that oil demand growth continues to flatten to where it becomes peak oil demand. China is not an empty narrative now.
We've certainly seen peak growth in terms of oil demand from China, and I think that sort of slowdown is going to continue. Now, then that we're not that close to peak oil demand in China. We see several 100,000 barrels a day of annual growth in demand for China, certainly through to the end of this decade and into the next decade. But it's clearly the case that EVs are making a substantial contribution. So oil demand, the focus of oil demand growth is going to shift to India and Southeast Asia away from China. But it would be a mistake to think that we're close to peak oil demand per se in China.
Let's go to the survey question, which is looking a little bit at this earlier discussion point. Why isn't oil joining all other markets and hitting records? Too much supply, uncertain demand, $80 is a fair price. It is the $30 silver. It is the $10,000 copper. Narendra, of course, we are still in this forever election cycle in India, getting near the end now. Always great to have your insights as to where it's going and what the outcome looks like.
Well, I mean, we are in the middle of the election season, as you know, and the last phase will take place on the June 1st, and on June 4th, we will have the results. And very exciting elections. And by the way, when I come to shows like you, as you know, I'm a member of the ruling party, but my profession is energy. When I come on shows, I'm brutally neutral.
Yes.
So so it's nothing to do with my political affiliation.
Of course.
So so I mean, right now my sense is based on my own travels across the country and interactions and what I see in the media and interaction with politicians on both sides. My sense is that the BJP will return to power, and with Mr. Modi back as the prime minister for the third time. But it may not be majority as big as, let's say, the party would like to have in terms of the alliance called NDA. They are seeking 400 seats in a parliament of 543. So that may be a bit too ambitious, but they may also be, the whole thing may be part of this strategy, psychological thing, targeting opposition so that they get demoralized. And they think, all right, BJP is like a very well-oiled machine, like a juggernaut, very difficult to stop. And that's all political strategy. But my sense is BJP is coming to power. But we may see a stronger opposition in parliament, which means that, this next parliament might be more vibrant. and opposition might be more assertive. And as you know, that Indian Prime Minister only yesterday said that, look, if some people are getting rich, we are okay with it, because then that wealth will be transferred to those who need that wealth. But everybody can't get rich at the same time. So it's nice to hear such vibes in India, because majority of Indians are still very socialist in their mindset.
And just on that point on the winning of the election, like in the UK, from a parliamentary first past the post system, you can have a majority but still only get around what, 40% of the vote? Is that more or less?
Even if you get less.
Less.
Yeah. So it's just depend. For instance, let's say the BJP candidate gets 400,000 and the Congress candidate gets 399,000, would still be the loser. Well, you'll be out.
And there might be many other candidates in that same constituency.
Yeah. So our system is not like in Germany or in Sweden. Our system is like in Britain. And so therefore it's very different. So people are used to it. But just to conclude on this,
please.
just conclude on this. I think, my sense is that Indian economy seems to be quite okay with it and happy with it, because the country is more kind of pro-reforms, economic growth, and people can see the benefit. At the same time, the government has made sure that those below poverty line, or those who need kind of economic handholding in terms of food subsidy and all that, that is available. Now, the Congress party, the opposition party, which is more left-leaning, has promised actually double for what the BJP gives to those who need food security help or handholding. They promised double. So that means that, even the left-oriented parties are turning a little bit right when it comes to such policy, which is not a bad news as far as Indian politics is concerned.
Peter, the other driver of the markets in general, all the financial markets, but oil supportive as well, is this continued expectation that we will get rate cuts this year. Your thoughts on that still floating after the recent CPI numbers?
Well, Sean, they were in some ways better than expected. So there was softness there. So that was what probably has prompted naturally a little bit of a tick down for US dollar. They're talking about rate cuts. I think a little bit of further hot air will probably come out of the US dollar in the short term. It's been pushed back. There's about a 20% probability of anything happening in June. So it's pretty much very much off the table. They're saying now it'll be September. You've got also, I think over this summer period, they've got a lot of heat starting to drive up with the debate series between Biden and Trump, how that's going to materialize, whether Biden's going to be dead man walking and they'll still have him there as president. His numbers aren't that strong. If they're going to see a change of batter, is that going to come in, before September? And is that shot in the arm going to be what the Fed probably does? And they can't do too much more than that, considering you've got, end of October, start of November, you've got an election. So that's where you run out of time. So that time premium, I think that's where it's at, Sean. One cut, 25 basis points, and everyone's saying it's done. So let's see and roll on into September.
David, last word to you with the survey result. I mean, all we've talked about in 30 minutes is quite a lot, obviously, but ultimately OPEC Plus are having to sort of digest all of these tea leaves and make a decision on June 1st, which is now, 2 weeks away. Your thoughts on where their decision could be at and which way you think it would be likely to go?
Well, I mean, I think a lot depends on the momentum in the remaining days of May. I think if we can continue to see crude shifting downwards as we've seen, really since the start of May, there might be some
start of April even.
Yeah, so there may be some pressure there for them to extend the cuts. I mean, my sense is there is room in the market for them to release some of that oil back onto the market, not all of the 2.2 million barrels a day, but actually we see inventories relatively tight, and there's therefore some room for some of that oil to come back onto the market. So a sort of partial patchwork agreement to release some of the crude back onto the market, but keep some of the barrels off to try and guarantee an $80 floor, I suspect is quite likely.
Well, this might be the first week in a few where oil prices close the week up from where they started, but only incrementally. So we have to wrap it up there for the end of the week. Brent currently trading $83.77. We'll see if there's more momentum in the up as Europe and America get into their desks and start trading this market. But where they will take further direction is a little bit hard to see. Thank you, as always. Great to have your insights and participation this morning. Reva Tania, India's leading energy expert, David Fife in Argus Media in the UK, and Peter Maguire, CEO, XM Australia, all the way over there in Sydney. Thank you, Peter. Thank you, David. Thank you, Narendra. Have a great weekend, everybody. All the best.
Thank you, Sean. Cheers,
now.
guys.
Thank you.